Hi, Brian. We are about to start. We're going to start at 12:30 as we wait for the others to join. Thank you for joining already. We have 3 minutes before we start. Yeah. We have 2 minutes before we start. Let's wait for the others before we can begin.
Hello, please enable participant screen sharing.
Okay. Hi, everyone. Thank you for joining us today. We are about to start. My name is Gertrude Njeri. I am the community manager here at Hisa. And our session today will be conducted by our financial markets analyst, Anthony Kiambati. I will be handing the session over to him in 2 minutes time. In the meantime, if you have any questions, leave them in the comment section and we will be happy to handle them as we continue. Welcome and thank you so much for joining us today.
Hello, guys. So, we're going to be talking about basically how to select good investments. And so, I want you guys to send in your questions before we start, so that I can be able to answer them as I do the presentation. Anyway, so I think we're good now. Get it? Very good. Gertrude, are we good? Are we good to go? So anyway, so let's go to the next page. So I'm going to take you through the process of picking good stocks, basically to add to your portfolio. And one thing you need to note is that you need to look at the stock market just like any other market where you're looking for good stocks. I mean, good for goods, which in this case, our goods are the businesses or rather the stocks that are selling at a bargain. So you need to look for goods or rather stocks that are selling at a bargain, buy them and then wait to sell them at a profit. But the thing is about the stock market. Unlike normal markets, in the stock market, you also get to enjoy dividends when you own dividend-paying stocks and etc. So you don't have to wait until you sell your investment to start getting returns, right? So I can see some questions on when you mentioned choosing human stock options or investing opportunities at every level. Basically, I'm going to talk about the products that we offer. That's stocks, ETFs, rates, yeah, etc. So not only stocks. So pardon for that. So let's get started. So let's go to the next page. So the first thing you want to do when getting started is to determine your investing goals. And the reason why you want to determine your investing goals before selecting your investments is because this will determine a lot on the stocks you get to pick and basically the approach you take when picking your stocks. So let me give you a good example just based on something like age. And so let's look at guys like, let's say, the young investors. So for young investors will be more interested in increasing their portfolio. That's basically a growth approach. And therefore they would opt for, let's say, something like growth stocks, small cap stocks, and penny stocks. Yeah. On the other hand, if it's the case for older investors, these are guys who are basically approaching retirement. These are guys who want to more preserve their capital. So they will take a different approach when selecting their investments. And the approach would be going for maybe value stocks, large cap stocks, or even index and bond ETFs. So I think by now you guys can see why it's important to determine your goal. So is your goal capital preservation? Is your goal growing your portfolio in a short period of time? Is your goal earning consistent income, etc.? So you need to get these things clear before even starting the process of selecting the individual stocks. On the other hand, we're still on this topic about your investing goals. Some investors might be, let's say, interested in generating regular income for investment, let's say in the form of dividends. Hence, they would opt for, let's say, the stocks that we call dividend aristocrats. These are stocks that have consistently raised their dividends for the past 25 years, or rather, they would even go for the real estate investments trusts. That's the rates, because one thing about rates is they give and 90% of the taxable income as dividends to investors. And for rates, you get to earn dividends monthly. That's for some US rates. Okay. So on the other hand, let's say your goal is basically to hold your positions and then hedge your existing position. And by hedging, I mean protecting your investment against downside risk. You take a different approach for this one. So you invest in, let's say, uncorrelated assets, or even betting against the market by investing in inverse ETFs. So that's the thing about determining your goals. What's your goal? What do you want when investing, or what's your target, so that you can be able to narrow down on the specific stocks that you want to invest in. So let me do a summary of that. So investors who are looking for growth, let's say the young investors, would be more drawn to, let's say, younger companies showing promising revenue growth, maybe with PE ratios that may be higher than the market average, etc, etc. So that this is for investors looking for growth. So investors who are looking for capital preservation, they'll go for the opposite. Yeah, they'll go for stable businesses that have been around for decades, producing steady and predictable profits. So a business like, let's say, Berkshire Hathaway, a business like, let's say, Microsoft. Yeah. On the other hand, investors interested in income will be searching for stocks with good dividend yields and the cash flow and earnings to support those dividends. Yeah. So this is an overview of how you determine your goals and the approach you take after determining your goals. So I think that's it for the goals. I think we can talk about the second step, which is finding companies you understand. So there's something that Warren Buffett says, and that's you should never invest in a business you cannot understand. And remember, in the first step, we talked about looking at the stock market just like any other market. Basically, you're investing in businesses instead of don't look at it as buying stocks. You're actually buying businesses. And one thing I want to really emphasize on when I talk about understanding a business, it's more than what guys think. Because most guys think I understand Safaricom because I know I use Safaricom on a day-to-day basis. I mean, I understand Apple because I have an iPhone, I have their products, I see their products all over the place. I think that's the basics of it. But when you talk about understanding a stock, or rather understanding a business, there are several factors that you need to be able to sort of um, elaborate, or rather understand, when if someone asks you, why did you invest in this specific company? Do you know their historical returns? Do you know the strength of the balance sheet? Yeah. Do you know the sustainability of the business model, and has the company offered consistent dividends? Yeah. So these are some of the things you need to know when I'm talking about understanding a business. And I'm going to take a lot of time on this specific point. That's number two, finding companies you understand. So one thing you need to note is when you're buying a stock, you're basically becoming a partial owner of the business. So if you don't understand the business, you're basically setting yourself up for failure. Okay. And one thing I want you guys to note is never buy the name. Yeah. This means don't just buy a company because the company is popular or you're seeing it advertising, etc. You need to do your due diligence and research how the company has been performing. Okay, so let's go through a simple example. Um, there's a company that has really caught my attention, and it's becoming sort of like my favorite right now, and that company is Microsoft. Yeah, Microsoft was launched by Bill Gates a couple of years ago, I think 1975 or something, I'm not sure. But rather, the company IPO'd in 1986. And let me now break down what understanding a company means. Yeah. So for me, the approach I would take is the first thing I look at when looking at a company, let's say a potential company to invest in, I look at their historical performance. Yeah. So for this specific specific company, already Microsoft, we already know their product, so that's not a huge issue. So I want us to look at, let's say, their performance, their historical performance. So for Microsoft, since their IPOs, they went public in 1986, they've had an average annual return of 31% since 1987 to 2022. So they IPO'd in 1986. So 1987 to 2022, they've had an average annual return of 31%. So basically, this is a company that's growing in terms of share price. On the other hand, we've looked at the all-time returns. Let's look at the 10-year average annual return. This company has had an average annual return of 27%, which is good in the past 10 years. So when I talk about the past 10 years, I'm talking about from 2012 to 2022. And then year to date, the company has gained over 20%. That's 23%. So which is good. So that's already the first step you've taken. You have understood the historical returns of the business. Okay, let's look at the sustainability of the business model. How is Microsoft sustainable? Or rather, what are the strengths of Microsoft? Or rather, what's the answer to the question? If someone asked you, why should I buy Microsoft shares? What would be your answer? So here's the answer. So personally, I'd say Microsoft has had a consistent increase, or rather growth, in revenue and profits for the past 10 years. If you can do your research and just check for the past 10 years, how has the revenue grown, how has the profits grown, etc, etc. So these are some of the things you can look at. And even before we look at the sustainability of the business model itself, let me just give you some basic numbers. First of all, this is one of the largest companies in the world. It's currently, I think, number 3 in the world with a market cap of 2.05 trillion. So this is already one of the stable companies in the world. And then on the other hand, let's look at a simple metric, something like annual profit margins. So the company has managed to increase annual profit margins consistently for the past 10 years, and currently the profit margin stand at 33%. That's a very good profit margin. Okay, and then so let's talk about the sustainability of the business model right now. Is this business sustainable? There are two things that I want you guys to look at. So Microsoft has business side, or rather a business platform called the Microsoft Azure, which is basically their cloud computing business, which is getting a huge boost due to increased demand. So there's a lot of growth in their cloud computing business. So that's a strength, yeah. And is it sustainable? Yes, it's sustainable because we're seeing a lot of growth in the cloud computing space. Number 2, let's talk about artificial intelligence. Everyone is talking about ChatGPT, and when you look at ChatGPT, Microsoft is one of the front runners in that specific area. So how is Microsoft, or rather, how is Microsoft positioned in the artificial intelligence race? Actually, Microsoft seems to be leading the artificial intelligence race. This is because they have been consistently investing in ChatGPT's maker, that's OpenAI. I think they actually invested in that company in 2019, in 2021, and the biggest investment was the one they did this year, where they invested $10 billion in ChatGPT's maker, that's OpenAI. So they wanted to sort of include ChatGPT in their search engines, that's Bing and their Word, PowerPoint, etc, all those products. And so these are some of the things that you can mention just to, or rather you can look at when trying to look at the sustainability of the business model. Does artificial intelligence have a future? Yes. The future is greatly rooted in artificial intelligence. So these are some of the things you can look at. Yeah. And talking about dividends, for dividends, Microsoft has quite a shortfall because they currently have a dividend yield of around, I think, 0.99%, which is quite low. So these are the pros and cons. So for the pros, you're getting a good return. That's an average of 31%, historical average, and return on your investment. But for dividends, you're going to get a shortfall. So for someone who is investing in Microsoft, the approach is not consistent income. The approach should be a growth approach. And that's why we tackled number one, determining your goals. What do you want? Do you want consistent income, or do you want capital growth? Yeah. So I think that was a good example of basically understanding companies. Yeah. Okay. So I see someone asking a question on the Q&A. Okay. So someone is suggesting that we should do webinars to show how to navigate the Hisa app. Yeah, we'll do that. So I think we have tackled that. That's basically finding companies you understand. Now, with that, you understand the company. Let's go to the third step. Yep. So what's the third step? You've understood the company, you've understood the strength of their business, you've understood the historical returns, you have understood the dividends, etc. So it's time to determine whether the company has a competitive edge. Okay, so that's number 3. Let's go to number 3. So when you talk about the competitive edge, there's a word that Warren Buffett likes to use called a moat. Yeah. So an economic moat is a distinctive advantage that a company has over its competitors that allows it to protect its market share and profitability. So when you talk about moats, there are various types of moats. So we can have the cost advantage moat. Basically, this is a company that is producing goods at the lowest possible price. We can talk about high switching costs. Basically, this is a company that is making it very costly for consumers to switch to a competitor. Then we have regulations mode. Basically, regulations can make it harder for competitors. And this basically, when you talk about regulations, you will see this in utility companies, or rather utility stocks, companies that distribute electricity. You'll find the government regulating a lot of electricity distribution. Network effect mode, basically more users, more value. And for the network effect mode, you'll see this in a company like Facebook or Meta. I think in their latest report, they reported that around, I think, 37 billion people in the world use their products. I think that's a huge number. We have intangible assets mode. That's basically branding, patents, trademarks. So this type of mode, you'll find it in healthcare companies, or rather companies that are doing a lot of research on basically vaccines, etc. Then we have digital modes. That's a large engaged audience. So that's the thing about a mode. When selecting a company to invest in, you need to determine what's their competitive advantage. What aspects do they have that will help them stay in the market for long? Do they have something that sets them apart from other companies? Yeah. So after determining that, another thing I want us guys to look at is number 4. Let's go to number 4. So number 4, we're going to determine the fair price of a stock. And when we're talking about the fair price of the stock, is basically the process is called stock valuation, basically. And at this point, let me remind you guys, we're doing a series of webinars. So last week we talked about basically investment strategies. Today we're talking about how to pick good investments. Then next week we talk about portfolio management. Then at some point we'll have a whole webinar on basically valuation itself, because we can talk about valuation today because valuation is quite wide. So we need to do a whole webinar on valuation, but I'll mention valuation as part of basically selecting a stock. So it's time to determine, yes, the company is good. yes, the company has a good moat. The company has a moat. The company is sustainable, has a sustainable business model. The company has had good historical returns. The company is aligned with their investment goals, etc., etc. It's time to determine, is it the right time to buy? The company might be good, but you might find that the company is actually trading at historical highs. Yeah. So that's another thing you need to check. Uh, you need to check the valuation of the stock. Is the stock currently overvalued or undervalued? And in most cases, the best scenario would be going for stocks that are sort of undervalued. And how will you do this? So there are a lot of ways to check whether the current stock price presents a good value for you. And you can use two types of analysis. So we have two types of analysis. The first one is what we call fundamental analysis, and the second one is what we call technical analysis. So what's fundamental analysis? So fundamental analysis is basically, I would define it as basically determining an asset's intrinsic value by examining the related economic and financial factors. Putting it simply, basically, when you're doing fundamental analysis on a broad basis, you're going to look at some ratios. You're also going to look at the books, the balance sheet, the income statements, etc., etc. And also, you're going to look at some other things like the management, the culture of the company, etc., etc. That that's all we have to. I mean, that's it. That those things fall under fundamental analysis. And then on the other hand, when talking about technical analysis, this is a type of analysis where you look at charts. This is basically for the guys who trade other currencies, for the guys who trade options, etc., etc. I know you guys know how to look at charts, but basically for technical analysis, you're basically looking at price charts. And let me also remind you guys that we'll have a lesson on that. So at some point, we'll do a lesson on how to analyze price charts. So I'll show you guys how to basically look at price charts to try and determine a good stock to buy. So what are some of the ratios that you can use? The common ratios used to determine the fair value of a stock are price to earnings ratio, we have price to book ratio, we have the PEG ratio, we have the debt to equity ratio, we also have the free cash flow. Yeah. So these are some of the ratios you can look at when determining the fair value of a stock. And with the technology that we have right now and the advancements that we have right now, you don't have to calculate these things actually. So a simple Google search of a stock, let's say you just search something like alphabet stock price. You'll find the stock price, you will see a chart. You can look at the chart. On the other hand, just below that, you will see the financials. You'll be able to see the PE ratio. You'll be able to see the PB ratio of the company and all other ratios that you need to look at. And when looking at ratios, something I want to mention is that always make sure that you compare ratios between stocks in the same industry or stocks in the same sector. Don't compare a PE ratio of a stock in the healthcare industry to a PE ratio of a stock in the energy sector. They'll be very different. So you need to compare. If you're comparing a stock like let's say Valero Energy, you need to compare the PE ratio of Valero Energy with the PE ratio of Occidental Petroleum because these stocks fall under the same sector. So it's important to find the average PE ratio of the sector and find and look at the specific stock that you're looking. Is the PE ratio of the stock below average or above average? And just a quick run through on how we use the PE ratio. P ratio is basically used mostly by value investors. It's basically a metric that helps investors determine the market value of a stock compared to the company's earnings over the past year. Okay, so the P ratio will be important because it will provide a criteria for comparing whether a stock is overvalued or undervalued, right? So a high P ratio could mean that the stock price is expensive relative to earnings and possibly overvalued. Let me repeat that. A high P ratio could mean that the stock price is expensive related to earnings and possibly overvalued. On that ratio might indicate that the current stock price is cheap relative to earnings. Hence, for value investors, if you are a value investor, you want to go for stocks with a low PE ratio. The same for PB ratio. You want to go for stocks with PB ratio. On the other hand, just to mention, the PEG ratio is usually an improvement to PE ratio. So PE ratio is the basic, but a more accurate metric to use is the PEG ratio. Sasa, and then the debt to equity ratio. So basically, these are some of the metrics you can use. I don't want to talk a lot about the metrics because we'll have a whole lesson on valuation. So I don't want to confuse you guys. So these are the steps that we have done. So the first step was we determined our goals. We also determined the history of the company. Do you understand the company? Then we determined, does the company have a competitive edge? And then we determined the fair price of the stock. Is it time to buy? Yes, the stock is good. Yes, the stock has a competitive edge, but is it the right time to buy? Is the stock overvalued? Is the stock undervalued? Finally, it's time to now pick the stocks, the actual picking of stocks. So let's go to step number 5. So step number 5 is basically, it's now time to shortlist your best stocks and build your ideal portfolio. So for shortlisting, you don't have to do it manually. You can actually use a stock screener. So you just have to search for stock screeners. There are many available in the internet. So you see, with the stock screener here, I'm looking for, let's say, the specific company. So I'm looking for a company with a PE ratio that's less than 15, a return on capital employed over 22%, sales growth in the last 10 years, and then profit growth in the last 10 years, debt to equity less than 0.1, cash from operations for the last year. These are some of the metrics you can use to basically narrow down on the companies. Yeah. So I think a homework for you guys, the homework I'll give you guys today is just search for stock screeners on the internet, and one of the best stock screener that's used by most investors is called Finviz. And so you can just use Finviz and narrow down on specific stocks. So do your research on the ratios, do your research on the specific companies. Just look for the specific companies. You can even start with the companies that you know, like Microsoft, Apple, Google. Just look at their historical returns. Look at their historical returns, look at what's their competitive advantage, or rather, and then look at their future projections. What is going to be the key driver of growth in the future? And then at the same time, look at the health of their balance sheet. Look at their financials, the metrics, everything. Yeah. So these are basically the steps you can take when selecting good investments. And I think today, what I did today was a basic overview. So all these steps, all these specific aspects that we talked about will all be individual webinars in the coming weeks. That's it from me. Let me get some questions from you guys. Or someone is asking, you said the best advisable screener is called, okay, the screener is called Finviz. Finviz, Finviz, Finviz. Any other question? Okay. So, if you don't have any questions, that's it for me. Have an amazing time.
Okay. What a session.
I think, Gertrude, I think, is there a question from someone called, I think, Brian? Yeah. Yeah. Brian, you're asking when is it recommended to focus on income growth over capital growth? Okay, so just as I said last week, guys, you need to have an income portfolio on your basically you need to have income stocks on your portfolio because you don't want. I think one thing that guys don't understand is these returns you're talking about. We're saying that Microsoft has returned on average 31% since its IPO. That's yeah. So that 31%, you can only realize that 31% when you sell that stock. So and you don't want to keep on selling your investment. So you always need to have an income stocks that are paying you dividends consistently so that you don't have to sell your stocks. So it's important to have both. You should only have a growth portfolio. You should have even an income portfolio. So that's it, guys. Have an amazing time. And is there anyone who is not in our WhatsApp group?
Anthony, there's another question from Njoroge. He is asking, is it possible to use stocks as a regular income?
Yes, you can use stocks as a regular source of income. Especially a good point for this is the real estate investment trust. Some REITs in the US actually give monthly dividends. So basically you're getting some income monthly. So you can check out some REITs. I think a good example is a REIT called Realty Income. So how do we choose a good rate? I think we have a lesson on that. So we'll have a webinar on that. But in the meantime, I'll send you a PDF of our previous webinar that we had on how to invest in US rates. So have an amazing day, guys.
Before we go, there's another question. Well, what is the progress with fractional income in Kenya?
Okay, so the regulation part is done. So it's only the actualization part that's left. So basically, coming up with the systems, etc. So it's something in progress. We'll notify you guys once we are done. How can I receive that? Receive all the document. I'm going to send it via WhatsApp. So that's what I'm asking. Every person who is in the webinar should join our WhatsApp group. So I think we can send a link or something. Here's the link. Here's the link. Here's the link. So I've sent the link. I don't know if you guys can see it. So just text me, and then I'll send you the link. Gertrude, share the link.
I think I can see it in the webinar chat. Can everyone else see the link to our WhatsApp group? If you can see the link, kindly raise your hand or just type yes.
So just change the destination of the link from host and panelist to host and the rest of the participants. So Brian, I've sent you the link.
Yeah, it has also been sent to everyone.
Yeah, perfect. So that's it from me, guys. Have an amazing day.
It was a pleasure having everyone. We'll see you in the next webinar next week, same time, same place. If you have any feedback on how we can improve the trainings, we are very open to feedback. So yeah, until next time, bye.